Okay, I'm going to move on to our next topic, which is the U.S. market. As you heard from John's presentation, our largest fund is in the U.S., and part of the reason for that is the U.S. market is 10 times the size, so there's a lot more deal flow. When you look at Vancouver, when you look at Canada, you've got Vancouver and Toronto dots on the map, and after that it gets skinny. So, Rob, I'll start with you. Given all the turbulence, political turbulence that's going on in the U.S. right now, you spend a lot of time down there. Does the U.S. market have more runway? And I have to ask this, has Trump, has he drained the swamp or did he fill it back up?
Well, I think any casual observer would see that the United States economy is running very well by almost any measurable metric. And I think if all the trade agreements that the administration is working on, particularly the one with China, get resolved, I think interest rates will remain reasonably low. My own view is that the U.S. has a very long runway. I hear other people, when I'm in the U.S. all the time, 5 months a year at least, say, no, we're in the 7th inning or the 8th inning. I don't think so. I think we could be in the 2nd inning or the 3rd inning. So I think it's got a lot of runway. There's some potentially serious poisonous issues, and the biggest single one to me is the very unnerving political discourse that's going on at the federal level. It's upsetting. The other thing that makes people nervous is that the Democratic Party has seemed to be taken over by its left-wing elements. And so that continuous ranting and raving and discussions of going back to 70% tax rates, that can't help but make people nervous. It certainly makes me nervous. And my willingness to invest, I sometimes question that because of what's going on. I think the other little thing that makes me a little nervous is there's, of course, a massive increase in the federal debt in the U.S., but also in corporate debt and personal debt. So unless the market keeps ticking along really rather very well, there could be a problem because there's too much debt. But there's no reason for the market not to continue doing well as long as there's continued good government. Because the United States really has everything going for it. So I'm cautiously very optimistic about continuing to invest in the United States of America.
I think the U.S. debt is often overlooked. It's very frightening, and next time just Google the U.S. debt clock, and you'll see the $22 million for the federal debt. When you add up all the other debt, whether it's university debt or the municipal debt or the state tax debt, it's like $160 trillion. It's a massive number, and that's frightening. I don't know how they're ever going to deal with that. So, Colin, you, in addition to Vancouver, you're also active in the U.S. How do you view the U.S. as an investment for your firm?
Well, we're down in Seattle, and we're doing a rental building down there. And the challenge for us in this market is Vancouver really is not a huge real estate market. So for companies like ours that have to grow, we either go east or you got to go down south. And for the product that we do, residential high-rises, there is a drive back to the urban core in the city, and we see that down in Seattle. I can tell you from a construction perspective, very, very difficult to get financing in the U.S. right now. And, we started investing in assets in the U.S. in 2009. It was pretty obvious that you were going to make some money, you're just going to get some cap rate compression, and you're going to see valuations. I think those kind of low-hanging fruit are done now, and you got to really rely on underlying rate growth. You might get a bit of bump in that because of the tax cuts that are coming through right now. But I think, like most markets throughout North America right now, you got to be a bit careful in investing. That's our where we're at right now.
You mentioned Seattle. We actually have 12 assets in our U.S. fund in Seattle. It's a logical place to start in the U.S. And we started buying in 2010. The U.S. hadn't recovered yet. Our dollar was $1.10. Yeah, it's never going to be like that again. We like that market. There's a lot of good stories, a lot of job growth, a lot of successful companies, Amazon, Microsoft, Boeing, it goes on, Expedia. Yeah. It's impressive. That city, being in the Northwest, often got overlooked, but I don't think it is now when you look at pension funds and the big investment groups from back east are going there. So Avtar, in your career, you dealt a lot with pension funds and these institutional groups. And we were talking the other day about how they've exhausted the opportunities in Canada and they've been forced to go to the US. Do you want to comment on that?
No question about that. If you Google even London, England, New York City, LA, the dominant buyers of AAA real estate, particularly from an office lens, has been Canadian pension funds. But they're migrating, they're very focused. It's hard to say, in my view, that the American market's got a long runway. There are so many sub-markets in America. You can also buy bad real estate in America. I think you really have to pick and choose your asset class and the city you're in and the purpose of your investment. When I look at what worries me about America, if you look at the two big negative events that we observed were the Resolution Trust days and then, of course, the meltdown in 2008. And in both cases, the real estate market was hurt because of over-leverage and overbuilding. So I wouldn't go into an American city or American geography where how many deals in America were 100% financing with no recourse? You can't do that in Canada. And you shouldn't be able to do it in America. But when the lenders get that aggressive and they're lending 104% of appraised value, not even the purchase price, and there's no recourse, and people are going to walk away from deals, and they go ahead and build the building anyway, that's when America's real estate market gets in trouble. But there will always be, whether this part of the cycle or this part of the cycle, there's always going to be good markets and not so good markets to invest in the American landscape.
I'll just touch on that because I'm down buying buildings with some regularity and financing them. The lending community generally is very cautious now. And not that they're cautious because they think things are bad. I think they're more cautious because they've learned their lessons. So you cannot, in my experience, over-lever assets at this time. You can get a reasonable amount of financing that's typically around 65 to 70, 75% maybe, but 65 to 70 is, is kind of normal now. So they've been burned a couple of times badly, and I think they've learned some lessons broadly. Again, in the U.S. cities that I'm in, generally in the South, we're looking for cities that have significant population growth, like Phoenix, 100,000 people a year, significant job growth, 80,000 new jobs a year. So if you're in those cities that have significant job and population growth, I think we're in pretty good stead for quite some time. I'm a huge Seattle fan, and I've been there for 20 years.